so that we don't have a problem with the storage and the conversion. Okay. All right. Okay. So here we are in terms of we talked a little bit about the modeling of maximum trade, maximum risk per trade. We talked about the Kelly formula and all that. That was in the previous session, so we don't have to go into that again. So here we are in modeling position size. We're talking about the currency market situation. Okay, so we are in this problem of DP7 and currency market calculator. We're trying to figure out how many units to buy or sell. And we are looking at the currency market calculations. And the first scenario we're talking about is what we are saying briefly here. This is a very specific kind of statement. The more general statement is over here. So let's look at the general statement first. The general statement is that when PNL is in the risk cap currency, okay, so risk cap currency means the currency in which your risk capital is denominated. So as in the case of this example, I want this auto hide the taskbar. I don't know why this is not disappearing. Okay, we'll just have to live with it since it's not disappearing. Okay, so the first general situation is when PNL is in the risk capital currency. So it is the risk cap currency, the currency in which your risk capital is denominated. All right, it's still not happening. So the first situation is the risk capital currency is the risk cap currency. By that we mean easier for me to manage this. Okay, so the risk capital currency in this side, you can see in this example, most of the examples that we are considering, the risk capital is in US dollars. That is the US dollar is the most important currency in the world, and it will remain so even for your lifetime. Don't believe the stuff that people tell you about China and India overtaking the US. It's very unlikely. Okay, unless they decide to become a socialist country or something, which it might be happening after the selection if Trump loses. But then otherwise, then that's a different kind of story. But if they remain on the path that they are on, nobody's going to overtake the US, not in your lifetime. Forget about my lifetime, not even in your lifetime. So the people who say all that, they don't understand anything. Okay, so risk capital currency is in most of the cases is in US dollar. The risk capital is in US dollars. Okay, so all these figures, these are in US dollars. That's what we're saying by risk capital currency. So the first situation is that PNL is in the risk capital currency. Okay, so that means that risk capital currency is the terms currency, because remember that what we said here that I dislike this thing blocking my way. Hopefully it will disappear. I don't know. Yeah, now it has. Just needs to be reminded. All right. Okay. So let's go back to first scenario, the very simple scenario, simple as I said here, simplest case, and you can understand scenario 2 and 3 as a slightly more complicated version of this, adding one more twist and two different types of twists to the simplest case. So simplest case, PNL is in the terms currency. So it's very simple. Your PNL is going to be your position times exit price minus entry price. And if you write your, and I think I've written it somewhere here, that we have one more principle we will write down here. Okay, so enter short positions with a minus sign. If you do that, essentially what will happen is this thing here, you can see this formula here, simplest case of a P&L. What is the P&L in a particular case? You've seen this also before. You have this. The P&L per unit is this. Okay, if you have it with entry, if you have this, you are considering a long position, entering at 23.5, exiting at 26. So we write the P&L as exit minus entry in all cases. As a general expression, we write exit minus entry. All right, exit minus entry, and we write the so this exit is the exit with loss. That's what we are really concerned with when we are modeling the position size. Exit with profit we are not concerned with at this point of time. So this is 2.5, which is the profit per unit, and you total profit you want to get, if you want to get the total risk or total projected loss on the triggering of the stop, that's 2.5 into the number of units. So this would be the, in this case, you have come up with these many units. So this would be 2.5 into this. Okay. So everybody's clear so far. It's common sense. All right. So this is what we are. And then because we are really concerned with the position, we are trying to divide, we're trying to model the position size. So this is how we use the language that when we're talking about models, if we say that I'm trying to model the position size, that means that I'm trying to derive the position size as a dependent variable. Okay. So here I was modeling trade P&L. So I was trying to derive the trade P&L as a dependent variable. So I start with that. That's why it says in the notes that you first start with trade P&L, you model trade P&L, then you get to the modeling of position size. Okay. So you have trade P&L is going to be the number of units times exit minus entry. And if you enter the short positions, if you enter the position size as a negative figure, because remember in the case of a short position, what will happen is if you take this dollar yen, okay, if I'm going short at 105.50 and maybe stopping out at 106, so that's how it will happen. So when I'm entering at the market and the stop is higher than the current market in the case of short positions. So when I write exit, so if I'm 105.50 is my entry and 106 is my exit, then what happens is that when I write exit minus entry, that is actually a positive figure, okay, because the exit price is higher. And if you take that positive figure and the position size is entered as a minus figure, the P&L comes out as a minus because you're always modeling, you're projecting the loss on the triggering of the stop. If this exit is the triggering of the stop, this is the exit on loss. Okay. So let me just write this here. So here, all right, so the other trick is basically to always enter short positions with a minus sign. And if you do that, you will see that you'll always get a projected minus P&L, negative P&L. In the case of long positions, the exit will be lower than the entry. So when you do exit minus entry, because when you go long, if I go long here at 105.50 and I have a stop at 104, so if I exit minus entry, it's 104 minus 105, that will get a negative figure, and then that's my long position. So plus figure into minus figure, that will be a minus figure, so you'll get a loss projection. So it will always work. Okay, so here's your position. So your simplest case is you have PNL is equal to position minus position times this, okay, and then you flip it around, you put position, it becomes exit, this exit minus entry divided by PNL divided by exit minus entry, okay. And remember here, what is the other thing we said? Trade PNL, it's a trade PNL that you're talking about, must be the trade PNL in the, we're always talking about the risk capital currency, okay. And we're talking about, you have to set the trade PNL equal to the maximum risk per trade, and that's how you'll figure it out, okay. So first understand the, so this position is here the PNL, this PNL is going to be the maximum risk per trade, okay. So here PNL is equal to maximum risk per trade. I'll repeat this condition here so that you remember easily what we are doing. Okay, so basically what do we do? What is our goal? We are trading in the Aussie. We are trading in the Aussie. Let's convert this to Aussie. We are starting from very basic scenario. And then we'll move on and repeat the scenario 2, which we did in the previous session. Okay, so we're trading in Aussie, okay, and we are trying to find out, we've decided everything. Remember, we have already solved all the other, we have to assume we solved all the other problems. Let's say I want to go short, okay, so my buy-sell bias came out on the negative side. I was a seller, and then I went to decide, I had a selling bias based on my chart analysis. Then I assume obviously DP5 is auto solved by assuming all entries are at market. So I'm going to go short at market, and then exit price with loss is easily determined. Let's look at this. So we have all of these determined. I'm going short at 71.50, let's say. And let's say I'm going, or let's match the figures over here. Let's match the figures over here. First situation, first scenario. I'm going short at 71.50 and exit price is 73. Okay, so let's assume that it's 73 for whatever reason. It's just 73. Just it doesn't make any sense on the chart, but we'll just take it like that. Okay, so it is 73. Let's say if I have X, so if I'm going short at 71.50 and the exit is at 70, at the stop loss is at 73. These have already been determined. My goal here, why do I need these equations? Because my goal is to really solve this problem. That I need to decide how many units to buy or sell, in this case to sell. Okay, number of units I have not yet solved, so I need to figure that out. How am I going to do that? In my trading system analysis, I already have a figure for maximum risk per trade, okay, which we have already done. So you should already have that figure. I have already formulated this expression. And then I'm going to set the trade PNL equal to this PNL here. This will be set equal to the maximum risk per trade. Okay, and then you divide this by this expression, and then you get the position size. So this is basically how you model the position size. Because you don't really know what you want to do in terms. You know that you're going short at 71.50. You know that you're stopping out at 73. Okay, but you don't know here how many. Here, this is your PNL, okay? 15K is your PNL. Let's assume that the 15K is the maximum risk per trade, okay? So you know this, this we had just done as an experiment. This -1 is just to -1. This figure is actually this into 1 million, okay? So this is just, instead of writing so many zeros, just 1 here. So what we do is basically this formula, we just put this formula here, PNL divided by this, okay? So if you see here, this is the PNL, okay, which is coming from here. Essentially, I enter this here separately, that my maximum risk per trade is say -15, okay? So I have my PNL here, and I have the other expression, exit minus entry. Exit minus entry is over here. You can see here, this one is exit minus entry, okay? This 73 exit price minus entry price, okay? So to make it easy to calculate, I've broken it up to understand it better. So broken it up into pieces, and then we are just dividing. So this answer, the ideal position size, this is the result of modeling the position size. The ideal position size is, as is given in our formula, PNL divided by this expression. Okay, you can see this PNL divided by this expression. Okay, so that's how you get. So this is how you model the position size. Okay, in the simplest possible case, where what is happening, because you're trading, your risk cap currency is US dollars, and you're trading in Aussie. Remember Aussie, because it is written like this. This is the convention. You'll see it's written like this. So here you can see that in the case of the Aussie, the terms currency is US dollars. Okay, so and your risk cap currency is also US dollars. So when PNL is in the risk cap currency scenario 1, that is risk cap currency is the terms currency, because PNL is always in the terms currency. Okay, so yeah, always means, okay, let me clarify that. Always is a very absolute kind of statement. Generally is in the terms currency, because the trading is always in terms of the units of the base currency or the base asset. So that's why the PNL comes out in the terms currency. All right, here, so this is how you have it. Okay, so everyone is clear about this. Everyone is clear about this modeling here, how to figure out the position. So what we are doing here is we are solving this problem. We are solving this buy sell position size problem for the case where we have we solve this problem for the case where we have the simplest possible case in the currency markets, where your risk caps in USD in all the situations, and we are trading in Aussie US, which means risk cap currency is the PNL currency. So simplest case. Any questions here? None. Okay. Now we come to a slightly more complicated situation, scenario 2, which we already did earlier. Okay, USD CAD. Now here, okay, what happens in the case of USD CAD is what is the terms currency here? Let's ask Akshita. In the case of USD CAD, what is the terms currency? Yes, Akshita. Okay, she's sleeping. Okay, who else is sleeping? Let's ask Priya. In USD CAD, what is the terms currency? Okay, she's also sleeping. Okay, let's ask Raghav. Okay, we'll come to Utsav later. Raghav.
Yes, yes, sir.
What is the terms currency in when we are trading dollar Canada? Okay, you see how dollar Canada is written.
Sir, USD.
So you're saying in dollar Canada is the terms currency is USD.
Yes, sir.
Okay. Okay, let's go to Utsav now. Utsav, you agree with him?
Yes, sir. In dollar Canada, the terms currency is dollar.
Don't say dollar because the
US, US dollar.
US dollar. You have to say US dollar because both of them are dollars.
In
Okay.
dollars, it's US dollar.
Okay. All right. Okay. Let's ask Jakar. What is your view? Two people have raised their hands. Srishti and Kanika. Okay. Jakar, do you have a view? Jakar is also sleeping. Okay. Let's ask Kanika.
Sir, it is Canadian dollar.
Canadian dollar. Okay. What is Srishti's view?
Sir, US dollar.
US dollar. Okay.
Yes, the Canadian dollars.
Canadian dollar. Okay. So we'll stop here. So Siddharth and Kanika are correct, okay? Because I've already told you the trick in the case. This is partly like knowing a convention, okay? In the sense that when you go to the US and you want to drive, you have to know that they drive on the right-hand side of the road. There's no logical, conceptual knowledge involved there. It is just a matter of knowing the context, the contextual information. So this is how it's done in this country. So you just figure that out. You have to figure out, you have to learn it from somewhere. It's nothing conceptual. Okay, it's just information. Like when an American comes to India, he learns that in India we drive on the left-hand side of the road. Okay, so the conceptual part is an understanding how the internal combustion engine, how the car engine works. Those things are conceptual. So here it is a matter of contextual knowledge, but I've already given you a clue that when you look at the way that currency market prices are, yes, Srishti?
Sir, according to what I understood in the last class, uh, I thought that Canadian dollar is our base asset.
Well, that's why I'm just coming to the rule. I've already given you guys this rule before, that when you look at currency market notation, it is always like this. Okay? It is generally given like this USD CAD. Either they will not have this forward slash, or they will just write it straight, and as in certain cases here, when I go for, let's say, USD by certain cases, as you can see, they write it like this, okay? And in certain places, most of the cases, there will be a forward slash in the middle. So in currency market notation, the first currency that is mentioned is always the base currency, okay? Our base asset. So, and the second currency is the terms. This is the convention in currency markets, okay? So this is how you figure it out. So this is, as I said, it's a matter of contextual knowledge. Okay, nothing conceptual about this, but this is the rule. Okay, so the one that is mentioned later is the terms currency, and you can also, and this is also all part of conventional knowledge, that contextual knowledge, that when you look at these, so that's why once you have that contextual knowledge, you know that when this chart is moving up and down, what is moving up and down is actually, what is fluctuating is only the number of Canadian dollars. By the way, you can see a beautiful high to high cycle in this limited view that we have. A beautiful high to high cycle, because high here, then low here, and then high here, all the way back to this level. Okay, so when this thing is fluctuating, this chart is fluctuating. What is fluctuating is actually the number of Canadian dollars required to buy $1 US, and it's only that $1 remains the same. That's why it's the base asset. Okay, so this is, but for all this, you need to know that contextual knowledge, which is the contextual information, that in the dollar Canada market, the US dollar is the base asset, and Canadian dollar Candy is the terms asset. Okay, the Canadian dollar is also called the loonie, because there's a bird called the loonie on, I think, the $1 Canadian coin. That's called. So if you hear the word loonie in the case of currency markets, they're referring to the Canadian dollar. Okay, so remember this, that the convention is in the currency markets, the base currency is mentioned first and the terms currency is mentioned second. So when you see this, so you know now that, so that's why if you saw in the case of the Aussie, when we were trading the Aussie, the US dollar was the terms asset. And that's why, because generally the PNL comes out in the terms currency, because trading is in the units of the base currency. So here what is happening is the terms asset, and therefore the PNL was coming out in US dollars, and that's PNL is also in the same currency in which your risk capital is. Okay, so risk cap currency is US dollars and PNL currency is also US dollars. The simplest scenario. All right. Okay. So are you clear now, you Srishti and Utsav,
Yes, sir.
all you guys,
Yes, sir. Yes, sir.
and Raghav also? Okay. Now you have understood that the base currency, terms currency in dollar Canada is Canadian dollars. Okay, everyone is clear now. Okay, so this is the convention in the currency markets. Okay, so now you have a problem, because now you see that your PNL is going to be generated in the terms currency, but your risk capital, which is Canadian dollars, and your risk capital is in US dollars in all the scenarios. Okay, so that's not good enough, because there's another rule here that trade PNL must always be converted to risk capital currency. Okay, because otherwise it doesn't make any sense. So when you have this, when you do this maximum risk per trade calculation, when you do this maximum risk per trade calculation, this is coming out in your risk capital currency. Okay, investable capital, risk capital. These are all in some currency, and that's your risk capital currency. And so when you're doing your actual trades, we had the discussion earlier, I think one of the sessions that Siddharth was asking about FIIs, foreign investors investing in Indian markets. So it's an American investor, let's say their risk capital is in US dollars. But when they trade in Indian stock markets, their P&L is in Indian rupees. So ideally, when they're doing their risk position size planning, they would have to convert that Indian rupee P&L per transaction, projected P&L loss per transaction. They would have to convert it into US dollars when they're doing the modeling of the position size. So that's what we are saying. This has to always be converted to risk capital currency, because when you're losing money per trade and you want to ensure that at the end of the day, even if all your losing trades happen together, that is here 93, 125, 74% losers, 93 losing trades. If they all stack up together and they happen one after the other, maximum, worst case run of losing trades, even then you don't lose more than your risk capital. That's why you take the risk capital divided by the number of losing trades. So this only makes sense if you are doing your actual trade modeling, your risk capital is in US dollars and your maximum risk per trade and your trade P&L projections per transaction are all in with the same currency. Okay. So now in scenario 2, we have a problem because our P&L is going to come out in Canadian dollars. We have to convert it into US dollars. So that's why what we do is we start with this basic expression. Remember this basic expression, P&L. Start with the basic expression here. This is recalling from scenario 1. Okay. Now here, what we have to do is once you take this, if you just take this part of the expression, okay, this is P&L in terms asset. Okay, so in this case of dollar Canada, we'll talk in terms of the Candy example. So here this would be Canadian dollar terms, okay, the P&L. That's not good enough for me because I need to convert it into my risk capital currency, which is US dollars. Okay, so here you have to once again remember whether you have to divide or you have to multiply, etc. That to understand that you have to first again remember what this is. Okay, any dollar Canada rate, what does that mean? Like right now the rate is 1.33. Okay, and what have I projected? In my, if I go to my scenario 2 here, what am I projecting? I'm projecting entry at 1.34, exit at 1.37, 137.50. Okay, this amount of position. Okay, to come out with this. And so here what I have is this is actually we are going to model it. Initially we just did this is like a double check. It's a cross check kind of figure. But essentially what we have is I have decided that I want to go short and my entry is here. My exit is going to be here. Now my problem is I don't know what my ideal position size is. I'm trying to figure that out. Okay. So I do know that the P&L in terms currency, okay, is going to be, if I do this kind of position size, just over $1 million, if I do that, the P&L in my terms currency is going to be this. Okay. So this is the exit minus entry price and times the position size, okay, which is this. Okay, this is my projected position size. This is here. This thing is coming out to be this that you see here minus 35K. This is basically this part. Okay, position size projected times exit minus entry. Okay, this is exit minus entry and times this. You can read the formula. Okay, and that's what you have. Okay, but this is not good enough for us because we want to have our P&L in the risk capital currency. Okay, so how do I get there? Risk capital currency is US dollars. So if it's 35K Canada is now basically at this stage you ask yourself this question. Okay, 35K Canadian is equal to how much in US dollar terms? It's the same thing. You already know all of this. All of you guys know this calculation already from your Indian rupee situation when you've gone abroad. Okay, So if you have, say, 75 million Indian rupees, how much is it in terms of US dollars? Okay, and the answer is approximately, say, 1 million US dollars. Okay, and how do you get that? You divide the 75 million, you divide it by the dollar rupee exchange rate, because dollar rupee also, remember, is, if you do dollar rupee, you will find that the dollar is mentioned first and the rupee is mentioned second. Okay? So here you can see how they've written it with the forward slash. It's a normal convention. Okay. So if that is the case, that means you know immediately that the Indian rupee is the terms asset, okay, and the US dollar is the base asset. And so how do you get from a rupee amount to a US dollar amount? You divide it by the exchange rate. Okay, so this is how you should remember these things. Don't memorize anything. Go back to thinking about how you would do it in the Indian rupee case, and that will give you the logic for every other situation which is like this. Okay, so US dollar Canada is, for our discussion, US dollar Canada is the same situation as US dollar Indian rupee, because both cases US dollar is the base asset, and Canada and India and INR are the terms assets. Okay, so therefore, the question that is there in our minds is, we got it up to here, okay, but this is the P&L in Canadian dollars. Now I need to convert it into US dollars. So what should I do? Divide or multiply? Well, figure it out. If you have a Canadian dollar amount, as in here, and you're asking what is this in US dollars, so do I have to divide or multiply? Well, the answer is you have to divide, because one Canadian, the way this market quotes, the way this market trades conventionally, is 1 US dollar is equal to X number of Canadian dollars, and that X keeps fluctuating. Okay, so here right now, so therefore what you have to do is divide by the exit price. Okay, because remember, we also have to figure out, the other thing that we have to figure out is this, we have to just write this again, where we have written it once earlier somewhere. At the time of realization of the loss, it's already scenario 3. I had written it somewhere actually. Yeah, okay. So yeah, this is actually, yeah, this is where I was going to write it in. So we already written this earlier, I remembered that. So not only do we have to convert the projected trade P&L into the risk capital currency, we also have to do that for a time which is, because here if you look at, there are two, already in our calculation, there are two exchange rates we are considering, okay? Entry price and exit price, okay? So which one should I take? And the answer to that comes from this guideline, that you have to estimate the P&L in the risk capital currency at the time of realization of the P&L. Okay, so therefore, first you figure out that you have to divide it. In the case of the candy, you have, in scenario 2, you have to divide it. Okay, because it is 1 US dollar equal to so many Canadian dollars. So to get the convert Canadian dollars to a US dollar amount, you have to divide by the exchange rate. And which exchange rate should you take, exit or entry? And the answer is exit, because that is when you realize your P&L, okay? Not at this point. Sometimes there can be massive differences between the entry price and the exit price. So therefore, it will make a very big difference in your modeling. So therefore, you have to divide by the exit price, the exchange rate. But which exchange rate? The exit price. So that's how you do it. Take this expression, divide by the exit price. And we had already derived this from in the last session. Okay, we got position size. So this is this. So this is just simple algebraic manipulation. Okay, so then you just convert it and you can see what happens. Okay, so finally you end up with this. Okay, this use of brackets, the convention is upside down, so just ignore that. Okay, so final result is this, because that's what we want eventually. Okay, we set the trade P&L equal to the maximum risk per trade, and we have position is equal to this. Okay, so we have put this model, we have done this modeling here, scenario 2, where we have, so I put this as, this is the maximum risk per trade, okay, and have I put the PNL? Yeah, so the PNL in terms currency, risk capital currency is just 25.455K, okay, let's put it this way. Okay, that's why that's the PNL. Okay, so when you see PNL, so we have two expressions here, two factors sort of. This first part, okay, so we have this broken down PNL into exit price that is given to you here. So where does it take the PNL from? It takes it from here. Okay, so here you enter the maximum risk per trade. You enter the figure in $1,000, and this one is just this into 1,000. Okay, so this is your maximum risk per trade, and that's your trade PNL. We have to set the two equal to each other. So this figure is here is exit price. Over here we're looking at this cell, which says PNL into exit price is this into exit price. Okay, that's one component, and the other component is exit minus entry, which is given here. Okay, so this, as you can see, is exit minus entry. Right. Okay, so as you can see here, this will come out to, if you take, and so then eventually what you do is for position, you divide the two components. So you take this ideal position size, is going to be this divided by this. Okay. You can maybe put this in bold. All right, so if you look at this, yeah, you can see it is C9 by C11. C9 is here, C9 divided by C11 is here. Okay. All right. So the main thing is here you have to understand stepwise. Conceptually, what you have to understand is that PNL is always in the terms currency, but you have to convert it to the risk capital currency. That's why you start with a basic expression. Okay, and then you have to divide by the exchange rate and you have to divide by the exit price, because you have to look at the PNL at the time of realization of the PNL. Okay, look at the risk capital currency PNL at the time it is realized. So that's what it is. Okay, so scenario 2 actually we had already done before, but I just did it once again. Any questions, guys, at this stage? Okay, good. So
Sir, I have a question.
yes.
Sir, you said that we converted when we realize the profit, like on the exit price.
Yeah. So
So, sir, for example, when I entered the market, the difference was pretty low, and then the difference, I mean, like say, $1 was for 1.2 Canadian dollars, and at the time of exit, it went to say two Canadian dollars. $1 went up till two Canadian dollars. So, sir, how will that difference be? That the gain which is there or the loss which is there due to fluctuation in foreign exchange, how will that be settled if I am only realizing it after I am exiting?
no, I didn't really understand your point. Point is, let's look at it this way. Let's say if you are going short at 0.9, okay, if you're going short at 0.9,
Yes, sir.
then you're cutting your loss at 1.5.
2.5. Yes, sir. So, sir, if I am only realizing the PNL at 1.5, that is my exit price.
Right?
Yes, sir. So, sir, the difference between this fluctuation difference also from 0.9 to 1.5, how will that be settled? Because that is also that will also be a loss or the gain depending upon the situation.
That is see, look at the structure of the formula. Okay, look at the structure of the formula. You can conceptually think of it as having two parts. Okay, the first part is here, which generates the PNL and the terms asset. And in the second part, you use a adjustment to, because this is not good enough for you, because the rule says that trade capital PNL has to be converted to risk capital currency. Okay, so here this part is in the terms asset. All right, so that is uh, okay. So I'm trying to fit everything into one line. All right. So here, this is the first part where you generate the PNL and the terms asset. Okay, and then you're just converting it into the risk capital currency, because these are all projected losses. Okay, these are projected losses because you're planning your trade. Okay, you're planning to enter at 0.9, and you think that by the time the market gets to 1.5, you will exit. Okay, this is how the thinking goes. All right. So you're planning the trade, and one of the important elements of planning the trade is to figure out how many units you should trade. And for that, with that in mind, you're trying to model the position size. Okay. And in that, you go through this. First, you model the trade PNL, you write the trade PNL like this, and then you write the trade PNL in the correct way, which is you write the trade PNL in the you derive the trade PNL expression in the risk capital currency. So you divide the Candy PNL by the dollar Canada rate, exchange rate, to get the US dollar PNL. Okay, so answer to your question, Utsav, is that this difference loss, that is factored in the first expression. Okay, because the first expression is exit minus entry. Okay, so if you increase this, okay, if you increase the difference between this, the number, if you look at the PNL actually will increase. Okay, the loss will increase. So let's say now what I'm doing is, you entered at 134. Now instead of exiting at 137, I'm going to exit at 1.75. Let's say. You see right now your PNL is 25K US dollars. Or you just focus to answer your specific question, just focus on the terms currency PNL. Okay, it's 35K right now on the old rates. I'm changing the rates now. The exit price I'm changing. See what happens to the 35K. You see what happens?
Yes, sir. It increased.
Yeah.
The difference increased.
Yeah. So that is, your loss is increasing from 35K to 410K, because your exit price is much further away from your entry price compared to the earlier scenario. Is this clear now?
Yes, sir.
Okay. So that gets factored into the. I think we can just do Control Z. Yeah. So this difference that you're talking about, entry minus exit, that gets factored into the first part of the equation. Which for first part, when you're modeling the trade PNL in the risk capital currency. LHS here is trade PNL in the risk capital currency. It has two components. RHS has two components. First component generates the trade PNL and the terms currency, terms asset. Second component here. Okay, you can take the dividing also as a second component, because it could have been multiplying also. Second component is divided by the 1 by exit price. Okay, so this second component, why is it required? It's required to convert the terms currency PNL to risk capital currency. Is everyone following so far? Yes.
Yes, sir.
Okay, good. Okay, so make sure these things, they look very complicated, but actually it's not complicated. Once you just understand, it's all common sense. Okay, and you have to follow the steps, and you have to apply the rules. There are rules that the PNL is in the terms asset, generally. Okay, and then the rule says you have to convert it into the risk capital currency. So you have to just, when you feel that the PNL is in a currency or asset which is different from the asset in which risk capital amount is defined. So here, PNL is in candy and risk capital is in US dollars. So we have to make sure that the formula converts the candy PNL into a US dollar PNL by dividing by the exchange rate at the time of exit. Okay, basics, very basic. It's not very complicated. Actually, it looks complicated because there are many steps to it. But actually, if you think about it conceptually, it is very simple. Yes, I hope everybody's understood it. Now, once you've understood this, the basic structure of this, if you understand it this way, it'll be easier to understand scenario 3 also. Okay, what is the basic structure of this equation? The modeling of the trade PNL, because once you model the trade PNL, then you just flip it around and just cross multiply, etc., and then you come and model the trade position size. Okay? And you set the trade PNL equal to the maximum risk per trade, which has also been modeled earlier as a function of investment capital, I cap and R cap, and number of losing trades. Okay. So once you've done all this, so the basic structure of the equation, you can even start from the simplest case of scenario 1. In all cases, you're applying the same basic structure, that the PNL in the risk capital currency should be PNL in the terms currency times some factor to convert the PNL in the terms currency into PNL in the risk capital currency. In this case, when you trade Aussie US, your PNL is in US dollars. And so it doesn't require a conversion, or you can, in general terms, you can think of it as PLN in US dollars is equal to PNL in Australian dollars, okay, divided by 1. Okay, this expression can also be seen as this expression divided by 1. Okay, I can also write it this way. Okay, in general terms, I think that'll be easier for you to remember this. Let's write it as divided by 1. Okay. Same thing divided by, now what is 1? 1 is actually the exit, is the exchange rate, because PNL is being generated in the same currency as the risk cap currency. Okay. So we can say PNL is in US dollars, risk cap is in US dollars. So, but if we write the expression in general terms and we write it as this divided by 1, what is 1? 1 is the exchange rate for US dollars into US dollars. Are you following my logic? Okay. So how do you convert 20,000 US dollars into US dollars? You divide it by 1. Okay. That's another way of thinking about it. Okay. Or you multiply it by 1, or whatever you do. It's 1:1 is the exchange rate for the currency when the currency is the same. Okay. So this is a general expression. You can think of it this way. All right. So I hope I did not confuse anybody by writing this. Okay. Maybe we should put it in small, but I think it's important to understand the general expression. Okay. We'll put this in 10. Okay. That is a general expression. So that means essentially what we are saying is, in all 3 scenarios, the general structure of the equation is the same when you're modeling trade PNL. The equation has, the RHS has 2 parts. One part is the PNL in the terms currency, and the second part is a factor used to convert the PNL in the terms currency to PNL in the risk cap currency. That's it. Everything is the same. Otherwise, you look at all these 3 scenarios, you'll get very confused, okay, because you're doing this stuff for the first, not that it's very complicated actually, very simple stuff, but because you guys are doing it for the first time, and there's a lot of, lot of steps involved, and so it may become you may get very confused, but don't confuse yourself. Remember this basic structure, okay, that all the 3 expressions are the same. In the first one, the divisor, etc., is just 1, okay, because you're just converting US dollars to US dollars, so the factor will be 1. In the second case, you're converting candy into US dollars, so you have to divide, because the exchange rate is, the base asset is US dollars. So you have to divide, just like in the case of rupees. to convert candy to US dollars, you divide it, and you have to be doing it at the time of exit. So you use the exit price. Now let's come to scenario 3. Risk cap is always here in this USD. Trading is in Aussie yen. Okay, so we can now look at Aussie yen. Okay, so we look at Aussie yen. Let's take this. All right, so in Aussie yen, okay, what we have is, what is the situation we have looked at? Situation 3. We are entering at 75.5 and we are exiting at 77. We are going short. Okay, we are thinking about a short trade. Okay, okay, 75, 77. It's fine, no problem. This is. Let's look at this. Okay, 75.5 and exiting at 77. It doesn't make any sense logically, because the highs and lows are different. But these are randomly selected numbers. Okay, I've entered it in the spreadsheet, so I'm not changing it. Okay, so I'm planning to go short at 75.5 at market, and I'm planning to exit at 77. The problem is, I don't know how many units I should trade. I want to go short, but how many units should I sell? Okay, that's what I don't know. So this is Aussie yen. Okay, so in this case, what is going to happen, Gagan? What is my terms currency here in Aussie yen when I'm trading Aussie yen? What is my terms currency? Yes, Gagan is sleeping. Okay, so we don't have much time, so I'll just tell you the answer. The answer is, the rule is what? That in foreign exchange, we write the base currency first and the terms currency later. So in this case, the terms currency must be Japanese yen. All right. Okay, so in Aussie yen, when we have any kind of loss computation, the basic loss computation formula, which is here, okay, this part, this is the basic loss computation formula in the terms currency for any situation. Short position should be entered with a minus sign, and the PNL is always to be entered with a minus sign in these kind of situations, because you're modeling the position size. Okay, you're eventually going to model the position size, and this PNL is the projected loss. Okay, so this is the projected loss, so it should be always put in as a minus sign, and the position for short position should be entered as a minus sign. So this basic expression will throw out, for scenario 3, when you're trading Aussie yen, the basic expression will throw out the PNL in the terms currency. Okay, so what we are showing you is in Aussie yen, okay, PNL in terms currency. So what is this? This is basically nothing but this expression. This expression applied to our situation in scenario 3, where we are talking about trading in Aussie yen. Entering at 75.5, exiting at 77, planning a short position. Okay, so if here I've just assumed certain amount in position size. Okay, so let's say, so this 1.5 PNL in terms currency is what? $1 million, not, remember, 1 million Aussie, okay, not 1 million US dollars. This 1 million is base asset position, so units of base asset. This is Aussie is the base asset. Okay, so here 1 million Australian dollars times the figure here, which is nothing but exit price minus entry price. That is written over here, which you can see 75.5 to 77 is 1.5 yen. This is 1.5 yen. Remember, because Aussie yen is the terms asset, which means if the exchange rate, somebody tells you, you call up your friend in Sydney and he says, oh, Aussie yen is trading at 75.5. What does that mean? That means one Australian dollar buys you 75.5 yen. Okay. So this is what it means. All right. So therefore, this conversion, this is your PNL in the terms currency. This takes care of your first part of the equation. which is this part. Okay. Now you have to do the second part, which is, remember, the second part requires you to convert the, now I'll just put some gaps here so that we can understand it better, or maybe I should not have put the gaps. We still want to see everything in one view as much as possible. Okay, so this is the first part of it. Let's focus on this part, is the conversion. Now think about this, what we have to do. This PNL is in yen, okay, because terms currency is yen. This is PNL in terms currency. Now I need to convert this into US dollars. Okay, so I can't. So therefore, what do I have to do? If you look at dollar yen also, how does dollar yen trade? In dollar yen, okay. What is, from here you can see what is the terms asset in dollar yen? In the dollar yen market,
Sir, yen.
yen is the terms asset. Good, because it is written later. Okay, so yen is the terms asset. So what I have to do is, therefore, if I have 1.5 million yen, just like in the rupee case, if I have 1.5 million rupees and I want to know the US dollar equivalent, I have to divide it by the dollar rupee rate, because dollar rupee and dollar yen is the same situation where US dollar is the base asset. Okay, so exactly the same as a rupee situation where I have 1.5 million yen, I need to convert it into US dollars, so I have to divide it by the dollar yen exchange rate. Remember that. There is no US dollar involved in this market. That's why I've written this situation, scenario 3. Scenario 3. What is the general definition of scenario 3? PNL is in a currency or asset different from risk capital currency. Okay, this is basically another way of saying risk capital currency. PNL currency is different from risk capital currency, and risk capital currency is not either of the assets in the market being traded, as in dollar yen. So risk cap currency is US dollars. Market being traded is Aussie yen. The two assets in this market are Aussie and yen. The US dollar is nowhere to be seen. So risk cap currency is not either of the assets in the market being traded. Okay. If you go back to dollar Canada scenario 2, the writing is slightly different. PNL is in currency or asset different from asset in which risk. So this whole thing means nothing but risk capital currency. The very long way of saying risk capital currency. So PNL currency different from risk capital currency. But what is the difference? Risk capital currency is the base asset in the market being traded. Okay. You saw scenario 1 where risk capital currency is the terms currency or the terms asset. Okay. Currency and asset I'm using interchangeably. Currency is a species of asset. Just like contracts are a species of agreement. So currencies are a species of asset. All currencies are assets, but all assets are not currencies. Okay. So some are commodities, some are debt securities, some are equity securities, some are real estate, etc. Okay, so coming back here, so what we have to do is that scenario 3. Just remember what you have to do and then proceed stepwise to do it. Okay, otherwise you'll get confused. Everything is logical. I have to, second part of the equation, what I have to do is I have to use a factor to convert the terms currency PNL into terms currency PNL. I have to convert it into my risk capital currency PNL. For that, what do? I have to divide by the exchange rate here. Look at this language here. Very complicated language. That's why I have said that. I have said this, okay, because his language is very big. So instead of writing this entire thing every time, I am saying that this thing, let's denote it by the sign @ When I write @ it we are talking about the exchange rate between the terms currency and the risk capital currency at the time of exit. Okay. Terms currency is this, risk capital currency is US dollars. Okay. So when you're trading US Aussie yen, you have to divide by the dollar yen exchange rate. Okay, something new comes in. Okay, so the dollar yen, so the projected exchange rate here, you can see projected exchange rate between terms currency and risk capital currency at time of exit. Okay, we should write that also. Okay, this is actually, both of these cases are referring to at the time of exit. I should not write this now because I have used at the rate for a different, now I should write the English time. Okay, at time of exit. That's what it is. Okay. So this actually here, this is an interesting case when you are, if you remember, if you think about it, if you start doing, if you're trading in very large amounts, okay, even small fluctuations in exchange rates can make a big difference if you have massive amounts of volume, okay. So it's very important to be precise. Now understand this when you're modeling the position size, and in this case, first we are modeling the trade P&L. I hope you can see clearly. I wanted to bunch it up together so that everything can be seen in one view. I'll just reduce it a little bit so that maybe it'll come, yeah. Okay, so P&L, as you can see, is equal to the two parts, first part and the second part. Second part, use a factor to convert terms currency P&L to base currency P&L. So which is nothing but exchange rate between terms currency and risk capital currency at the time of exit, which is my dollar yen exit. So when I'm exiting my Aussie yen position at 77 at this time, I have to make a projection about what the dollar yen exchange rate will be at the time that my stop is getting triggered. Okay, I'm entering here, my stop loss is here. Okay, my stop order is here. So at the time that my stop is triggered, I will realize a certain loss in the terms currency, which will be 1.5 million yen. This much I know for sure. But what I don't know is what this will be, what will be the US dollar equivalent of this loss. That is this loss in the risk capital currency. That I don't know. And actually that is not possible to model accurately to the exact point because you don't actually know. There is no way to figure out, to be able to predict what will be the dollar yen exchange rate at the time that the Aussie yen hits 77. Are you guys following what I'm saying? That's why it says projected. Okay, so when you're modeling, so far the situations of modeling we looked at, everything is quite precise. Okay, we know the numbers, but actually you have to understand here in this modeling equation, there is a problem actually, because the second part of this equation of the RHS, this is actually a variable which the value of which we do not actually know for certain, and we cannot know for certain no matter what you do. So this is going to be an estimate. That's why I said projected. Okay, so you have to project when this stop is triggered, you realize a loss of this much in P&L currency, in terms currency. But that's not good enough for you. All losses you have to understand in risk cap currency. And so risk cap currency is basically, the risk cap currency is to be the loss in risk cap currency as we figured out by dividing this by the terms currency to risk cap currency exchange rate. Okay, where you have big, in the case of dollar yen, because this is yen, in the case of dollar yen you have to divide because in dollar yen, yen is the terms currency. And so you have to make a projection about what would be the dollar yen rate at the time this is triggered, and then for that I've made a projection of 105. Remember, this is just a projection. Okay, so in scenario 3 you have some uncertainty because this, now based on this you come out with a position size of this, but there's uncertainty here because you don't know this for certain, because this figure might be dramatically different from what you're projecting. But once you do it, it's the same thing. The formulas are the structure is the same. Factor 1, factor 2 on the RHS, okay, and then you model the trade P&L, and then you do some cross multiplication, etc., and then you come out with, okay, position figure comes out to be this. You can work this out for yourself and see it's the same thing. All I've done is that instead of having to write this whole expression every time, I have just said, okay, let me denote this by the sign at the rate. Okay, and then I've used at the rate in the formula. Okay, that's what it is. You can look at this later on. I think we are already a little bit over the time, and since we have to take a break, let's stop the session here. Okay. Yeah, the alarm is on. I don't know why somehow it did not run. Okay, so we're 3 minutes over the time. So we'll be back at 11:15. Okay, we can start at 11:20. We'll just give you a little bit extra time. Anyway, we'll start, but make sure you're well in by 11:20. Everybody should be in. Okay. All right. So we'll end this meeting now.
Okay, sir. Thank you, sir.
All right. Okay.